Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Russell Rhoads, Head of Research at EQDerivatives, to discuss the futures versus spot relationship for both VOLQ and VIX. Russell, tell us about this particular relationship and why it is important for traders.
Well, first off, I have to give credit where credit is due. I was doing an event last week. I was on a panel with Scott Nations, and at the time, he pointed out that the VOLQ future was at a premium to the spot index, and we're looking at the front month October, while the October VIX future was at a discount to spot VIX. And I had not looked at contango and backwardation for each of the individual markets and compared whether that disconnect shows up. I started putting pen to paper and found that about 1 in 4 trading days, one of those will be in contango and the other one might be in backwardation.
What's significant about that? What makes it interesting?
Well, what's significant about it is typically when we end up in backwardation where the spot index is higher than the futures contract, it's an indication that the futures traders do believe that the spot index will come down between that date and settlement. So when we get inverted, it's usually when we've had a run up in volatility and there's an anticipation that volatility expectations are going to move down. Well, when there's a disconnect between these two, when, for instance, VIX is lower than its front month future and VOLQ is higher than its front month future, that means that maybe the implied volatility anticipation for the Nasdaq is that it's going to stay a bit elevated, whereas for VIX, it might need to do a little catching up with the futures contract. Just because in my mind, I felt like broad-based implied volatility would always kind of have the same outlook. I was really surprised that, again, backwardation and contango disconnects pretty frequently, or more frequently than I would have expected between those two markets.
So how can a trader take advantage of this?
Well, one way to go about taking advantage of it is a lot of traders out there like to be short volatility on a fairly consistent basis. That's the core strategy behind some hedge funds out there. Well, it's more difficult, or it's less palatable sometimes if the futures contract is at a discount to the index, because the index needs to come down some to push the futures down more. Whereas if the futures contract is at a premium and the index doesn't move at all, as we approach expiration, that futures contract is going to drift down to the index. So taking an individual directional position on volatility, whether it be bullish or bearish, might be dictated by what the curve's looking like. One other thing, and I've got a pair trading background, but if the front month is if the front month future in VIX is at a premium and the front month future is at a discount for VOLQ, that may open up opportunities for spread trades. And in the discussion that I had with Scott, and we've had a couple of follow-up discussions, he said he's been doing work on this and they have seen opportunities around this. So this is a work in progress, most definitely.
All right. Appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.